cash flow is important because while people might not pay that premium price for my unit, I'll still be making money because if a physical or economic asteroid hits the United States, tenants still need somewhere to live. And if the dollar rapidly starts changing up or down, that rent roll is going to reflect where the dollar went. And that cash flow is more important than what price people are paying today for the property. So long as we know we can keep paying our expenses, keep paying our debt, and maintain the asset.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Bradley Kirschbaum has been investing since 2012, and he's personally grown to love real estate over the last decade. Right now, he's transitioning to a full-time general partner role after being 10 years as a helicopter pilot. Bradley, welcome to the show.
Hey, thanks, Sam. I'm glad we could catch up after meeting at the Best Ever conference.
Absolutely. Had a blast meeting you then as well. That, of course, is a great conference to go to. Yeah. Looking forward to that one, as always, every year. Tell us, 90 seconds or less, where did you start? Where are you now? And how did you get there?
2012, I graduated, started making my first real paycheck, and immediately knew I wanted to be investing my money so it would work for me. And long story short, I really started focusing on the stock market, started focusing on things that were fairly easy to get into, and got to know equities and understand that side of investing fairly well. And the more I understood it, the more real estate looked attractive to me. That's really the long and the short of it. You do have to realize that there are a lot of things out of your control when you buy into equities. Limited amount of stocks have cash flow. And once you look at why you're investing and what you're trying to get out of that, you really have to focus on the fact that it's not just about growing your nest egg. It's not just about growing some bank account into a certain number you think you need to hit. It's about being able to cover down and cover your life expenses, your business expenses, and the unexpected next month. If you can't do that next month, what does 25 years down the road matter? It really doesn't. And that's one of the aspects that I find attractive about real estate is that you can find very solid cash flow or dividends, if you will, from your rental income, which when you look at the different products people invest in, rental income, it's not a sure thing, but a lot of your customers want to pay that check, right? Compared to buying into an Apple product or the next software product, whatever it is. People know every month they're going to be writing that check. And that's how I start measuring the stability and kind of the risk evaluation of why I'm buying into one product or another. So I've got a million analogies and a lot of things to say on that. But when you talk about growing wealth, I like the stability, the scale, and the cash flow of real estate.
You've been a limited partner, what'd you say now, for 6-7 years? Is that right?
I think my first investment as an LP in a real estate investment was 7 years ago. Yep.
Okay. What's your goal long term? Is it to be a general partner? Not you are a general partner, but to have a giant active portfolio, or is your ultimate goal to be a passive investor?
Oh, that's a good question. Sometimes I question that myself. Life ebbs and flows, and some days you want to build the dominating brand of the industry, and other days you're like, man, why don't I just treat myself to sitting back, picking out deals from my laptop and drinking cocktails on the beach, right?
Right.
But for the next 10 years, I'm dead set, in my group, Symphony Capital Group, we're focused on building a brand that's synonymous with some of the biggest in the industry. And we enjoy and we like getting into the weeds on all of these things. And being an LP is eventually the end goal. And I think, down the road when I've got a little less energy and I want a little more time to myself, I'll enjoy looking for great groups and other people to invest with. But for now, I enjoy bringing my capabilities and my understanding of this business and this market to other people, and being able to run a business model off of it is just the cherry on top.
What are you looking at right now on the active side of things? Like where do you guys see opportunity?
So there's a lot going on in the market. A lot of aspects are shifting. All the prices are different than you would have seen 2 years ago. And in the course of real estate, that's basically things changing in the blink of an eye.
Right.
I'm in favor of a few things. Fundamentally, I'm in favor of anything that has heavy cash flow, because, all returns are really theoretical until they're in your wallet. And as you receive your cash flow, you're really taking risk off the table. And of course, as I alluded to before talking with you, if you're not getting paid, that investment is just a rock and it's not really doing anything for you. Right. So I'm a fan of that. But in some of these hot markets, there's things that can't be ignored either. I mean, people are, using this large delta between the previous rent roll, or I should say going rent rate of a market that was seen a year or two ago to what people are paying today. And because of the large delta, how quickly that's changing, syndicators and groups are able to do some interesting number manipulation and get into a property and get out of it in just 2 or 3 years and make some serious equity for investors. And I'm not going to ignore that opportunity either. And right now, Symphony's seeing that throughout Texas, in particular in the DFW, Dallas metropolitan area.
We're seeing that. Obviously we're all seeing that. Is there any concern that the music will stop and maybe that same 2 to 3 year turnaround that we've seen in so many properties? I've been a recipient of that myself. It's been great. But what if the winds shift? Then what do you do? Yeah.
So I'm not sure that the window will last, right? This rapid of change would basically annihilate most of the population of the United States. I mean, if we keep having rent increases of 10 to 15% or greater in the major metros, it just very quickly will not work, right? There are huge growths in the populations that we've been hunting around. So it's not just about rent growth, it's about more foot traffic, more individuals needing units. That's huge and critical. But at the surface level of our underwriting, we're really ensuring that should the rapid rise stop, whatever number it stops at, we don't need an increase, right? So where we're buying today, our numbers on a 5-year plan work out with very minimal increase of bottom line cash flow that the property is currently creating. We don't really need the market to rise, but that's a huge cherry on top and enables those very quick transitions in 2 or 3 years. That, being able to do that and get a property off your hands and provide people a substantial return in 2 or 3 years is the icing on the cake. But realistically, we're prepared for much longer holds, and that's what we underwrite to. Being able to condense everything into a quicker timeline is just a bonus when it's achievable.
Right. Tell me about your expectations on cap rates, and maybe compare that to rising interest rates. Do you think there's a correlation there? I hear this both ways on the show all the time. One's like, no, there's not. Yes, there is. What's your take?
So I've read so many articles and listened to so many people. Ken McElroy is great. I love his data. Neil Bawa has some interesting data. And I'm starting to fall into the camp, and I think I've been falling into the camp of there just simply isn't enough inventory. And that's probably a greater factor on cap rates than interest rates have been. Even if interest rates go up another 100 bips, they're starting to trickle up there. And the Fed has finally established that they're officially raising them this year through a series of events. But even if it jumped back up to 2 years prior, the current rate 2 years prior,
right?
We've pushed another $24 trillion into the economy.
Right.
Like that money's going somewhere, that's spreading out, and that money's pouring into all different types of assets, including commercial real estate. Combine that inflow with just the simple fact that another 100,000 people moved to Dallas last year, right? And by the way, how many units were created? I don't believe it's even 1/12 of the amount of foot traffic that came to Dallas. Right. That's a huge, huge supply demand issue, and it's not going to be alleviated quickly. So there are great fundamentals here at play. And one note that I want to attach to this Federal Reserve conversation, and I think everyone should consider it, is that most of the individuals I talk to who are 65 and older, and I'm talking to them because I'm looking for some advice, or one or two of the specific people I'm thinking of, that they are mentors to our group more officially or so. And they never, ever considered the Federal Reserve rate prior to about 2009, right? That was not in their daily conversations. That's something that we've become fixated on. That's something that's become powerful. That's something that's become a part of public policy. Modern monetary theory has become a dominant conversation and course of action in Washington, D.C. But interest rates existed in the 70s. And in the 70s, they were not concerned with where the interest rates were moving. Of course, they cared about what their debt was. Of course, they cared about what the rate would be. But the general conversation over what the Federal Reserve's actions and activities would be for the rest of the year was not being discussed. And why? Because at the end of the day, regardless of what the Federal Reserve does, human beings are going to need units. And if there's more human beings and not an increase in units, that supply demand issue still favors the investor who's accumulating real estate. Right. If I can add another 30 seconds to this with a slight shift of gears, it would be that at the end of the day, even if you are paying a premium, and we do not do this, but when I do see teams beat us at best and final, and there are individuals that are paying a price per unit that seems absurd, or people wonder how you could ever make money, right? The real key right now, and the fact of the matter is that people need to be getting out of cash and getting into assets. And the only way to create more money than what you currently have today is to own an asset. That is more fundamentally important to your value and your ability to create more money than what price you purchased at. You cannot expect, let's say, real easy example. If you hang on to dollars, you're probably going to lose somewhere between 5 and 10% on that dollar over the next year.
At least.
Right. If you purchase a piece of real estate and you pay an extra 5% more than the next guy, you've already, shielded yourself from inflation, because now you own an asset that is going to appreciate with whatever that inflation is on your dollar. And in the next year, you're quite simply going to recoup that overpayment, right? There are a lot of fundamentals here that people are ignoring. And I think it's just very important to realize how many people and how much cash is really flooding this space right now. And I think that will continue out for the next 2 or 3 years.
Oh, for sure. And there's two different, people, schools of thought there. There's someone, and I'm not going to name names right now, but they're pretty prominent, and they're an advocate of a potential short window of deflation coming. And I'm like, I just don't see it. Like, maybe I'm wrong. And they cite, some pretty historical stuff. And I'm like, well, that's interesting, but we've never printed this much money. So, finding things that you can reprice with inflation, as you're saying, you buy it today. Okay. So you pay 5% more for it. Can you reprice it with inflation? I hope so. And that's the question that we ask commonly on this show is, at what point in time, can the rent increases? I know you guys aren't necessarily underwriting rent rate increases to be a critical part of your business plan, but at what point in time does the end user the tenant not be able to keep up? If they at some point they're just like, I just can't pay anymore. It doesn't matter what the demand, how much they need it. If they just can't afford it, then it becomes I don't know. It'll be an interesting thing to see how it shakes out.
This is what's important too. And I know you have a certain flow to your show, Sam, but I want to throw another 30 seconds in here, because this point I made to a potential investor the other day really summarizes my train of thought right now in this hot market, right? Let's imagine an economic asteroid hits the United States.
Okay.
You know what will happen? People probably won't continue to flood into real estate as investors. A lot of people have to change their decisions. A lot of thought processes will change. A lot of people hit hold. And that's why the cash flow is important, because while people might not pay that premium price for my unit, I'll still be making money, because if a physical or economic asteroid hits the United States, tenants still need somewhere to live. And if the dollar rapidly starts changing up or down, that rent roll is going to reflect where the dollar went. And that cash flow is more important than what price people are paying today for the property. So long as we know we can keep paying our expenses, keep paying our debt, and maintain the asset, I can wait 5, 10, 15 years, theoretically, to outlast whatever is keeping people from wanting to purchase multifamily real estate. And in the meantime, I've got that delta. I have that cash flow coming in from the tenants who pay us for what is currently something they desire, a place to live, four walls and a roof. Even if investors don't desire the property, the tenants still desire the property. And that is what protects you with those short-term hiccups and the potential for something crazy to go down in 2022. I'm not too concerned with what happens in the next 6 or 12 months. I'm concerned with whether or not I could theoretically hold this asset for decades.
Right. When you guys underwrite, are you underwriting an exit in 5 to 7 years? I mean, because that's a lot of times what people I think are wanting. Investors, I talk to them, hey, all right, yeah, we'd like to, double our money in 5 years, if we can. And obviously it's all projection. Like you said, I think the word you used earlier was theoretical. It's theoretical until you have the money in your wallet. I'll quote some guy named Bradley on my show. So, I mean, is that what you guys are doing? Is underwriting 5 to 7 years with that asterisk saying, hey, you know what? That's if. And otherwise, we're just going to hold it and collect the coupon along the way if we need to.
We are doing it to 5 years on every property we've entered into. And here comes the big caveat, because I find interest in holding for decades.
Right.
It's hard to convince investors to continue to hold when today we could give them 2x their money and we could do it at a very nominal, if any, tax liability, right? They're like, what are you talking about? Give me my money.
Right.
And then my question always is, what are you going to put that into? When you're 2xing something in a couple of years, that's a substantial change in your portfolio. I mean, that's great. Whether it's a large piece or a small piece of your portfolio, 2xing just naturally makes you want to receive that income and take your gains. But, again, we're going to be around not just for 2 to 5 years, but we as people are going to be around for hopefully another 30, 40, 50 years. And that's what I'm worried about. And when you go back to what could happen in the environment, I want to keep holding so that the tenants pay down our debt service coverage ratio, because that's true wealth. Doubling up your money, that's fantastic. You're getting rich. Having an asset that has a larger and larger delta between, remaining your asset or needing to be sold, that's so critical to outlasting those economic events that are eventually going to happen as the money makes its way through the economy and other factors come up. There will be issues one day. And I want my delta between covering my expenses and being forced to sell the property to get larger and larger so that I sleep better at night. Sure, that means holding off on taking that sweet equity increase that we're doing through forced appreciation. But that means my cash flow will continue to go up and my investment will get safer. And when you go back to why am I investing, it's so that I can be 60, 70 years old with a very stable portfolio, with a very stable income. And guess what? Waiting that long coincides with paying off that assets. It coincides with making this asset safer. So we are pursuing, and I think as time goes on, myself and the Symphony crew will pursue working with more investors who have that long-term vision. And there are interesting things where you could even hand off and kind of sell yourself your short-term flip, if you will, that was a 3 to 5 year business plan, and sell that to your capital that's interested in longer hold. And you create some efficiencies there, becomes less expensive for everyone. But really, we are interested in decade plus holds. And in the long run, I think that'll continue to be more attractive as the ability to quickly flip becomes harder and more difficult.
Right. Yeah, I love that. And that's I'm starting to see that shift in the investor conversations. I'm hearing that more and more. People are like, I love the equity multiple, but it's also really nice just to have a set it and forget it, never have to find. I mean, that's another problem. I'm sitting on capital myself right now, and I talk to at least 7 people a week, deal sponsors I could put, passive income out there, with, and it's like, I'm not even sure where to put it. And I think other people run into that too, where they're like, all right, so much opportunity, but what makes sense right now? Where do we as passive investors want to put money that it makes sense? You double their money, it's cool, and then they're back to square one, going, okay, now what do I do with this? Right. And again, that's a good problem to have. It's a great problem to have, but it's also just another one of the kinks in that equation where people go, okay, maybe we do hold it for a decade or longer. What does that look like? Can we harvest the equity through refinance and continue to hold the asset? Man, that becomes a very, very attractive thesis. So love you breaking that down. Thanks for doing that with us, Bradley. And thanks for coming on the show today. Certainly appreciate it. Last question for you is this. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Bradley at symphonycapitalgroup.com. Symphonycapitalgroup.com is obviously our website. I'm very easy to find on social media. Right here, this side, there's the info right there as well for those of you who are watching this. But I'd love to talk to anyone about anything in this industry, both as a GP and an LP. I think it's a great setup. And as the syndication industry grows, I think, it'll only become a more and more refined situation with more and more people aware of there is something else out there besides Wall Street to invest in, and a way to do it without needing to put a whole lot of time or effort into it via the traditional methods of investing by yourself in real estate. There is a great and a better way.
Awesome. Bradley, thanks so much for your time. Do appreciate it.
Thanks, Sam.